inflation, of course, casting its own huge shadow across crypto and the global economy in general, with worries about it gripping markets and consumers alike. What is ahead for digital assets? That is a question we come back to time and again, isn't it? Well, Damien Lowe of Matrix Asset Management is going to help us try and answer a little bit of that right now. He's here with us. Damien, listen, Goldman Sachs just warned that inflation in the UK could jump to 22% next year, a staggering number. It is jumping everywhere, though. How do we position ourselves as crypto traders in the midst of all of this?
I think digital assets are definitely an inflation hedge on the long term. I think in the shorter term, just like all assets, it will start to get depressed as central banks hike around the world. Inflation is here to stay, so central banks will definitely be hiking at least for the next foreseeable future. Why inflation is here to persist is because the systemic factors of like energy, food, and just wage inflation overall is causing it to stay for the near term. And there's nothing the central banks can do in the short term except to hike rates to assuage those effects.
And liquidity, of course, the other side of this worry as well. Rising interest rates likely to hopefully combat inflation, but also going to be sucking money out of the system as a result. That will hit asset values. Where do Bitcoin and Ethereum fit into that?
So I think there are definitely inflation hedges in the long term, and the big reason for that is that you can anticipate their supply by looking at how they were programmed or designed. That's not the case for dollar fiat, and I think while it looks very fine and dandy now for dollar fiat, the paradigm shift when it switches, when people lose trust in it and decide to go for other assets overall, will happen fast and furious. The merge is something that helps overall Ethereum. I think there was some kind of scalability issues, and for it to really be its objective of the world computer, this is a first step, but it's definitely not the end step. There's a lot of steps on the way. But I think given how it's been very cooperative, there's a foundation behind it, and it's really taking it to levels to get it to the next level where everybody and anybody can use it without crazy gas fees is a right step in the right direction for me.
And Damien, what are the other downside risks that you are building into your models then?
So I think it's the same boogeyman, but I think with different drivers. So what I mean by that is natural gas pipeline from Russia has been switched off, and that's really going to affect Europe, especially when winter comes. So inflation might actually spike even more. So it's more of the same thing, but in a bigger magnitude. So that's really going to hurt markets, I feel. OPEC has also decided to curb limits on or actually increase their production overall. So that's gonna hurt things as well, overall in inflation land. The other thing is that a lot of people have priced in that the Fed would be dovish, but we've seen already in Jackson Hole that they didn't want to give the markets that kind of perception, and I think they're gonna keep driving that in because it's not fully priced in that the central banks are more hawkish than markets had hoped for them to be. So I think that's further downside risk to watch out for overall.
All right, Damien, thanks so much for that. Damien Lowe from Matrix Asset Management.